All right, guys, welcome back to the channel. My name is Brian Johnson. I am the CEO of Nexyz Capital, and today I am with Primo Galicia, who is the CFO of Cashflow Stewardship, Inc. They are a corporate investment company located here in Omaha, Nebraska. Primo, how's it going today?
I'm doing fine. Thanks for having me on the show today. I really appreciate it. We'll have some fun.
Yes, we are. A lot of fun today. Yeah, I got some questions off screen here. So if you see me look to the side, I'm just looking at the questions that I have here for Primo that some of you guys sent in to us to answer. So first question up is, what type of companies do you guys look to invest in?
Well, just put it to this way. Whenever you're looking at, there's a couple different stages. So you think about a person's going through the process, and when they first start a company, what they say to themselves is, I'm gonna go out and I'm gonna borrow money from the bank. They may even use their credit card. They may even go get a small business loan. They may have those opportunities. Then from there, they're saying, hey, I want to go do bigger things. Well, for me as a corporate investor, or just as an investor in general, just as an individual, I'm gonna look at somebody who actually can keep money.
Yeah.
At the end of the day, there is an entry and then there's an exit. The exit is already predetermined before the transaction even started. So that's tremendous pressure on somebody who's looking to get funds to get their product or whatever what we like to say, product evaluation they put in the market. They got somebody who says, oh, yes, we can get the asset, we can be with you, yes. How much money we want to make? But here's the thing, everybody wants to look for 10X. And they can't make for 10X, they're looking at for 5X.
Yeah.
And they're exiting within 7 years. Minimum, maximum 10. But by that 10th year, they are really bugging the heck out of it. I mean, people ask me, what do I mean bugging? That means I'm really pressing the gas to, like, we have to scale up so I can exit, because this investment is fixed. So you got to take in that consideration as well. Is it a growth company? What is the asset the person looking at? When I'm looking at investing in a company, I actually prefer growth.
Okay.
I prefer growth companies, to be very honest with you, because the upside to that is tremendous with a strong management team. From somebody who can actually be obedient. People don't understand this, but wealth comes by obedience, the same way as being on time to work.
Yeah. Definitely understand it. Yeah, I know I've always heard the saying, it's usually related in the sports. It's this, if you're early, you're on time, and if you're on time, you're late.
Yes. Yes.
So you always want to make sure that you are early.
Yes.
Especially when it comes to your business, So, and that leads to another question, which we brought up, like the management team.
Yes.
So like what do you look for in a founding team or a management team that helps you decide which company to take a stake into?
How committed they are to their own resources being put into the deal. So here's the thing. Everybody wants that opportunity to be able to say that they have the right, or they got the opportunity so they can go in and get involved in investment. Everybody wants that. They actually will put their best foot forward and only have about $1,000 into an investment, $10,000 to $100,000. You're asking somebody for anywhere between, and I'll go on a scale. You got some companies, you think about Shark Tank, a person comes in and they're looking anywhere between 50 to about a $2.8 to $3 million. So their valuation that they have is pretty much 10 times earnings, with earnings not even being relevant at this point.
Yeah.
So I'm looking for a management team that knows how to generate money. Irregardless how well their product sells, they know how to still generate money. So you're looking at individuals who are willing to be, one, adaptable. Two, the second most important thing is that they want to protect the vision. What they protect. So you got somebody put the vision out there, where they protect the vision. And how do they respond to a phone call from someone more experienced? Do they find it as a rebuttal? Like, I always use this example. You know that saying where you accomplish it, and I'm going to use it. This is I'm using a term that men and women can understand.
Okay.
I used to tell my wife, early on in marriage, please make sure your toenails are always painted, because I knew when it was an argument, I can only look down. I just look down on her feet. I don't want to see chipped feet, So
yeah, I think as a guy, we've all had that.
Right.
Let me take this argument and gotta look down. Yeah.
Right. So I'm looking for a management team that's polished. That when you're talking to them and they look down, they see support. Not that they see, oh, this person's attacking my ego. Yeah. At the end of the day, that's what it's a room full of assumptions, ambitions, and egos that have to get down to fundamentals and systems.
Yeah.
And egos don't like systems.
Very
To
true.
be honest with you. So I'm only looking at individuals who are willing to follow system, because if you pass away, this company has to exist. And I tell young people, I can stay up all night till I figure out what X is. X is the problem in the business that need to be resolved. I need to make sure I can find somebody to do that. I'm not gonna be up all night solving the problem. They're sleeping all night, and the next thing you know, they got the money, and now I have to figure out how to, almost as if take a more of a controlling state to get my money out. My goal is not to. My goal is to work together, and they're able to extract. We're able to extract without impeding the company from growing.
Okay. So, with that, do you guys typically take a seat on the board, or do you let the initial founding group handle that?
Absolutely. No, we take seats.
Okay.
Seats.
Yeah.
We take seats.
With an S.
Yeah. Seats, yes. Our interest is important. What ends up happening, though, let me just tell you this. And people say, what do you mean? Okay. You got a teenage child. You give them access, and you add them to your bank account, your main account where your joint finances for the husband and wife go into. So you're already laughing.
Yeah.
You're laughing, because it sounds like that's a bad decision, doesn't it?
Yes.
Okay.
Yeah, a very bad decision, yes.
And you tell a child, if you need something, you can go ahead and take it. Even if you give them a limit. So, if you need something up to $300, you can take it. Do you know they will press that $300 limit?
Yes, because I think about my own child. He has a tablet. He likes to play Roblox, and giving him carte blanche on the, hey, you can only spend this much money. He's definitely going over.
Well, adults are the same way. First of all, they're in a new experience. They got access to funds that they personally don't know how to derive without the attributes of someone coming in that can do it. So you give them that kind of resources. Their first feeling is actually not fear. And I don't mean fear like afraid of the money. I mean fear like I need to be cognizant that once this money is misappropriated, I'm going to have that conversation.
Yeah.
So a lot of times people say, okay, what happens if I did get access to this money? And because if your person's out here and they're seeking, and I'm going to use low numbers to make it that anybody can understand, they can actually deal with a corporate investor, or they could deal with pretty much a corporate company that does investments that will do early stage investment seeking seats. And we're just referring to in the local market. So we're not talking about a company that has anything to do with registration and securities at this point. This is early on. I want to mean as early as possible. I'm saying that when the person first has the idea and they start going to the concept stage and the prototypes, the concept stage is the part of where you put the vision down. The prototypes is when you start allowing people to interact whatever it is with your product. Even if it's a 3D model. If you're in real estate, you got a 3D model, you would have put the money into that. My concern would have been at that early stage is before you build a 3D model, before you do it, let's find out will people be even willing to move into the 3D model. And if you built this in this area, how would it affect the city? Will the units be leased out? I make that statement because in China they have so many vacant places. In Detroit, Detroit has property right now, and I don't say this to tell people about real estate, but I'm talking about commercial property that's abandoned and been abandoned for years. That's on the city books. And you would say, well, what does that mean? It means that even if a company goes into Detroit, they have to put a substantial amount of money into an area that economically, it probably can maintain it, but the risk factor of your employees coming to work in certain areas of Detroit is not conducive. So people are leaving Detroit, companies are leaving Detroit. Some went in during the last administration, but now in this administration, it's gotten worse.
Yeah.
With the whole thing where police can't actually be peace officers, where they can't do policing because if they do, they be in judgment. So do you want to go into that area? That's that part where you first get involved. Because it's that part of that concept, because what is somebody looking for that has access to cash? And you have a person that needs the cash. What they really looking for is saying, I can't do all this by myself. Yeah. So I got to have somebody who can do it, and I also want to continue to generate money. But it's impossible. So that's what the whole concept of angel investors. Your family members and friends. Yeah. They're probably one of the worst investors. I always tell people that your family members and friends are the worst investors, but they are needed though, because that's where you get the greatest challenge. And I said, well, when I'm meeting somebody, I said, did you ever talk to your family members and friends about it? No, not really. How come? See, because they know aspects of your character that I don't know. And if your families and friends are giving you a hard time about the investment, most likely it's because of consistency area in the past. This is like your fifth business, this is your fifth concept, this is your eighth idea. So there's a lack of resiliency to follow through. It's not like you started a business and as you operated that business, You got it up to the point where it's profitable and you sold it. See, now you're an entrepreneur that can start and sell a business.
Yeah.
Now, if that business doesn't exist after you leave, that's not your issue. You got it to the point where you got up and sold it. And I tell people sometimes who are not proficient in resiliency, get a business up for $30,000 then sell it. You know, I've been telling people that ever since 2023. And that's because there's an ineptitude where people are saying, if I just get money, we'll be fine. No, go through the process of starting something that you spend less than $5,000, getting it up and running, and then sell it for $30,000.
Interesting. Yeah, I can see that. I can see that. Yeah, I know you brought up the asking friends and family for money, and they're the ones who know your character better than someone like you who's on the outside. Kind of just brings up like the Kevin Hart and Jay-Z interview where he said his family member asked him for $4,800 and he wouldn't give it to him, and he was like, oh well, he's a billionaire. But Jay-Z knows this guy. How many times has he asked him for money in the past and it didn't really work out?
Yeah. And that's more common, and I'm going to tell you the reason why. Because it has to do with a mechanism when it comes to people's overall personality. That the concept, the assumption that what I have right now is going to make me rich. Actually, that's not what's going to make you rich. Discipline is going to make you rich. It's really a disciplinary factor. Because if you give somebody, most of us, regardless if anybody give it to us, we can fool our way into a job where we get paid the most. I always tell people we mean fool your way because you're taking a job based on income that you have yet to do, and your application or your resume is full of deflections. It's not as accurate to some of your bad behaviors because nobody's going to put on the application, I'm not going to do this, that's not my job description. You're not going to put those things that we verbalize once we're on the job on. Then if let's say you come late to work, you're not going to put that on the job description.
Yeah.
But you're now getting money for a position that they need based on a qualification you have to grow into. And I tell people, you have to grow into that. Well, if entrepreneurship and being able to operate money, what you're really saying is that I'm going to build wealth for other people. That's really what people are really saying. I accepted that for myself. I decided a long time ago, Brian, that I was going to go and I was going to build wealth for other people first and myself second. Now, that didn't sit right with my loved ones.
Yeah.
But you got to understand the aspect of it. The reason why I'm second is because I'm a stewardship over the money they gave me first.
Okay.
So it's not that I'm saying that I'm not putting myself first. I'm placing discipline first, which is a stewardship. This person allocated funds to me, and yes, they may not look over my shoulder. They may not see that I might have, went and got 2 laptops versus 1.
Yeah.
And one I really use for my personal use, the other one I use for my business use. But I kind of go back and forth on it, but I got one for my personal self too.
Yeah.
So if the company was a fold, and I had to liquidate, I'm not liquidating that personal computer, even though it was not used with personal money, So you take the position that says, all right, stewardship. They have to get a return before I do.
Okay.
Now, how do I get them to start reserve from day one? From day one, you start keeping a return for the individual. If a person says, I'm looking at getting annually 10% return and it's $100, well, that's $10.
Yeah.
Okay, well, my first 2 clients I made 20. That discipline saying, well, here's the 10 already for that. They're like, well, no, we're gonna keep growing the company. Here's the thing: this person gave you the $100. Do you want another?
Yeah. True.
They're not asking you to take the 100, drop it down to 90, and give them back 10. That's not profitability. All you're doing is returning their original equity stake. If they're equity, if it's a loan, you made a payment, but that doesn't remove the fact that you owe them $100. That's just interest on the money. You still got to grow the value of the company. And as of right now, you can see from all those companies that went that are in the market even now, businesses that they started too fast and they didn't have resiliency and they didn't have disciplines.
Okay. Now I know the answer to this, but I know that people at home probably don't know the answers to this. You brought up corporations.
Yes.
Now, as a investor yourself, people start a lot of different business entities, LLCs, they throw an S-Corp on the LLC, C corporations. What type of entities do you guys invest in? And I guess most other high-level investors as well.
That's going to be subjective. Let me just explain why. But for me, because you asked you asked the question, if it's up to me, I'm going to invest in another C-Corp. If it's up to me.
Okay.
Now, I could tell you that, let me give you an experience with an LLC. Okay. When you normally have an LLC, the normal mindset, I'm just going to tell you that, if an accountant is helping you or a lawyer set it up, their normal mindset, you're not going to make money your first couple of years. So just think about that. The reason everybody say you can go get an LLC, one, you want legal protection. Two, you're not going to, as long as you don't co-sign for the company, you're going to limit the liability. Okay, you still as an officer or a member man, it's called member manager. To be honest with you, you can modify you have an LLC. First of all, the tax form is a 1065. That's what the IRS requires. Everyone gets a K1, but it doesn't have a mechanism to pay anybody, and that's why I try to tell people. The reason that you hear the term S subchapter S, that's actually an IRS exemption to allow a company to actually make payroll. That's really what a subchapter S is. It allows for them to do two things: take losses on the K1 and then make a payroll. Okay. However, the concept, just thinking about it, was like, oh, my first 5 years I'm not going to make money. Do you think I want to invest in that?
No.
People say, what do you mean? Well, most companies don't make money the first 5 years. It depends upon how they structure. When you grow, when you put so much money in that it takes you 10 years before you have productivity, that means either you have a large amount of inventory, or second, your management, because you're gonna have cognitive. You got so much money, and I've seen even people who are experienced make this mistake. They roll dice and figure out they're gonna do this. That don't work. They don't do this. So they start to do research and development improperly.
Okay.
So if it's to me, it's C-Corp. It's a C-Corp for a specific reason. A C-Corp is expected that everybody gets paid first. So the concept of not getting paid, you can't have that with a C-Corp. It's expected that you'll get paid. So the whole concept, people say, well, I have a company and I haven't got paid since I started. It's been 3 years in business. I know that to be a complete lie, just to be quite honest with you. They use the term draw, but it's really income, okay? But for that C corporation, for that person, it's expected. So now they're working within the expectations. Two is, if you wanted to get out of the company itself, do you know what companies actually get purchased more than any other company? Just in the United States?
Let's see. As far as
for acquisitions.
For acquisitions, I'm going to say C corporations.
100%. So another C corporation, and very few, because of the way that people do what we like to call creative taxes. Mm-hmm. The C corporation is easily to be consumed inside of an organization because it is structured based on systems. It's not structured based on you. You can have an LLC and the entire system is based on that person's skill set. So if that person goes out and they're able to generate $2 million or maybe $50 million, they hit their capacity, right? You remove them from it, the whole entire company is built on their actual traits. Nobody's gonna be able to do anything with that when that person leaves. You pretty much, the $50,000 that person was made is probably gonna tumble down to around 40% of that if it's acquired. Because that person leaves. So that means that, is a person going to take 50 million as a sale and then remain as the driving force to make the 50 because now he has people around him to define the system? That's one of the problems. My first thing with an LLC, my first experience was that the accountants and everyone else was trying to make sure, no, just don't worry about making money. I completely did not understand that concept. Like, what do you mean don't worry about making money? I made some obligation before I decided to get in this business, and they're due every month.
Yes.
Oh, the first couple of years you're not going to make money. What kind of confidence do I got in my accountant? And I began to ask those questions. If the goal of it is, if a corporation is there to generate revenue, and I am expected not to make revenue, that was my first introduction to the LLC. And then I made money. And they was like, oh, you got to pay all of this in taxes because that K1, and then you find out these individuals, they don't tell you that if you go and you get an LLC, mm-hmm. You know what happens? It's considered the term is considered here a disqualifying company because it ends up being a sole proprietorship because it's just one member. So one member in an LLC is you get taxed at 48% of everything you do. Not only if you put money into it, if the company has any money left. So now you're in a position of accumulating stuff as if you're back to being a consumer. I call it buying more stuff that's going to end up in the garage.
Yeah, and we've all bought stuff that just ends up in the garage.
Right. It's a storage unit.
Yeah, that's why
Basement.
I call a treadmill. It's just a clothes hanger. You buy it, you put it in your room, you use it for a little bit, and next thing you know, clothes start piling up on it. Well, you just bought yourself an expensive clothes hanger.
that actually rolls while you're walking into clothes.
Or you'll put it, you throw it in the corner. It's dusty now. You never touch it again. So yeah, I completely understand that concept. Like I said, I know that from working with you guys. And helping me understand that, because I've been the guy that, let me start this LLC, and not knowing, because you hear it, you can save all these money on taxes, but at the end of the day, that's hitting your own personal tax return. It's not really separate, and finding out that an LLC was actually made for a C corporation.
Yeah, but it's holding in. An interesting thing too, Brian, is this: is that it's advantageous that people accept this. An accountant is not an investor. Now, you would say if you do find an accountant as an investor, he does accounting on the side for extra money, but he does entrepreneurship as his main thing. Because when we use the term investors, we're really talking about having a stake in entities. That's all we're talking about. Whether it's equity or preferred stock. Preferred stock, you say, what is a preferred stock? That's where the company goes and gets a loan, but except the loan is using their stock in their company in order to make those payments. It's not where they go get a bank loan. They just sell shares, and that's considered a loan, and you must make a contribution payment on a monthly. Either we can do monthly, annual, semi-annually, or quarterly in that regards. Okay. But if you don't go to apply to bank, you issue stock that's preferred, which goes in the first position, which means now they become the number one creditor of the company, and everyone who has an equity stake is actually second. They're going to get paid first. Before any owner gets any money back, capital return, or any profits or dividend, they must get paid first. And that's really a tactic. If you as a corporate investor, you kind of make the decision. If you really like what they're doing, and you say, well, I don't trust how I'm going to respond to these people if they misappropriate these funds. So I need to put some more security in. So I want to be able to have board seats, some equity shares, as well as some preferred stock. Yeah. So I'm gonna literally, I call it the iron gill. Yeah. I'm going right after everything. Yes. You see where I'm coming from. And if I like it, but I'm really concerned, I'm gonna try to have the majority of the board seats. If it's 5 people, I'm having 3 seats.
Okay. So guys, when you're starting a company, you want to make sure that your co-founders that you come in with understand business.
100%.
Because if they don't, I mean, you can get them up to speed. It may take some time, but we all know that we have those people who want to be a part of something, and as soon as they come in, they don't want to do any of the work.
No, really. Okay, this is a phenomenon that only happens when you're going to family members and friends. Okay. Families and members and friends, in their mind, it's this statement: I can put as little bit as much in, and you can make me wealthy beyond the capacity I have. Now that really comes in the fact of the matter when we raising our children, and us as parents, we put stuff on credit. Back in the day, it used to be layaway. Yeah. When's the last time you heard that term?
It's been a while.
Right. So layaway, parents will start going, because we're getting close to that Christmas time. So I mean, layaways normally had 6 months, 8, 9 months max that you do layaway. I don't remember 12 months, but I just remember, talking to my mom as a child, and she said, I lay away, I only have 6 months to pay this off, but she will always do it 6 months before Christmas. So everything was already gotten, 6 months or in advance. If anything would have came out, you wasn't getting that to your birthday or maybe another. It wasn't coming in the year that it was, because she already got it on layaway. Now, that was the understanding that you could actually begin to lock up things, and they had these big places that had storage. Now, that concept came from that parents' money, kids just live off their parents' attributes. Mm-hmm. And today we still see that phenomenon, but in a different way. Parents have all these kids in these different sports. They're staying in a hotel, they're on traveling teams. So the child in their mind, they don't realize how much debt their parents is going, laying away things on credit cards, equity, they doing HELOCs, just so these kids can have these activities, and they're not going to go pursue this. But the reason I gave that reference is because when you have that concept and then you go after family members and friends who are normally using a layaway process to get an item, they don't want to break even. They're excited about, shoot, Brian's gonna do this, man. If he's rich, I'm gonna be rich.
Yeah.
No, he's gonna be rich, and you will receive a nominal amount that's allocated you based on the amount of money that you gave. So if you put in $100 and you make $250, they'll be very upset. Well, why do I only make $250? I saw you twice in the last year. You don't even ask me questions other than how fast can I get you that $150 on the $100 that you gave. That's not actually a person who is considered a fiduciary. They're disconnected from the responsibility of return of capital. So, you see it. There are some people who are lucky enough that their loved ones bestow upon them tremendous amount of money, but they have surrendered that over only for that effort to go by the wayside. Because they're gonna take that money, and instead of growing it and them learning how to grow money themselves, they're just gonna go to straight shopping city. There used to be a show called Supermarket Sweeps.
I remember that show.
Okay.
Yes.
And at the end, you have to figure out what these items are, find it, be very familiar with the, I would say that every husband need to do supermarket sweeps and let their wife go the week before and tell them all the items they want, and then then the store knows they're coming in. That way you can get those items, don't forget it, because they have a different cap or something on it, right? So you don't break stuff on the I asked you to get, what. From a standpoint of a person, your fiduciary term is going to be very important, even for my sake, because I'm looking at a group of individuals that's responsible to give me a return.
Okay.
Now, they don't have to give me a return, which means that they do it without my guidance. That means I work with them to get a return. So it's not all on them. I play a role in also getting my return.
Yes.
But they can also impede the return by certain decisions. They go against returns. So it's important to understand that may be the first thing you start off, but you need to go to the next tier. What's the next tier? Someone who's not a family and friend, and they consider them to be angel investors. Somebody in your local community that's an angel investor. You met along the way. But even that, you have to do, if they didn't co-found the company with you, and let me just say this for the record. Anytime that you're going to get money, and it's not from your immediate household, and you're going to get it outside, do you need to make sure that you check with your state, in the state where you live and you work. The state has policies on what you must meet in order to do certain things when it comes to money that's outside. If it's you and your wife, you don't have to talk to the state.
Yeah.
If you and your brother, you don't have to talk to the state. Because that's immediate family member. Somebody said, well, if it's his brother, you need to talk to the state because it's not your wife. The interesting thing is, it depends on when they get involved.
Okay.
If the company's already formed, you need to make sure you check with whatever state that you live in, look at the state regulations and see what they require for you to give to someone who wasn't there. And I say that because of this, even though you didn't ask me the question.
No, believe me, it was on the list. So let's go ahead and jump into that right now.
And that's because of this reason. The state has certain verbiage that they want included inside any type of documentation for a person who wasn't there when it was founded. Prior to the founding of the company and it being established. Now, what do I mean by founded? A founded is not when a person comes out with a name. This is the definition of a founding of a company. It's when you go and you get either a locality license, maybe you're sole proprietor, you get an EIN, and then you open up a bank account and you deposit $1. Now the company has been founded. People say, "Oh, I founded the name." When was it established? When did those three things take place? Because that's legitimately what a business actually is. Yeah. These are the three things. It's not a website. It's not business cards. It's not it's not a print of my company name on a hat. Those things are not it. I just try to tell people that's not it. They say, "What do you mean?" Okay, it's just the name of a company that's registered in the local city, county, or the state, LLC or C-Corp. You can't file a subchapter S in the state. That is an exemption for the purposes of the IRS. Okay. It's a way so that you're able to be taxed. People confused. They're like, "I have an S corp." I say, notice my facial expression. Yeah. I say nothing because I said, all you told me was an exemption that you filed. You filed 1120 subchapter S form. That's an IRS thing. Yeah. What you filed in the state, I don't know. Later you come to find out they have an LLC that they attached a subchapter S for. How come that's important? That's now considered an established company. It's been founded. If the company's founded. If prior to the company being founded, there are decisions that's being made that's inclusive. It includes everybody who founded the company, but actually it's exclusive for people outside the company at this point. So the state has regulations for a person who's been excluded when a company was first started. They have no protection. If they give you money, they take in 100% risk, even though you have money in the investment, and then they don't have money at that point, and then they now come in with money. You actually have precedence over them. So the state has policy for that.
Okay.
And so you just want to make sure you follow those policies. And each state has a policy, and each state has certain verbiage that need to be in the information, so that if that person was to lose money, the state says, well, you already knew now.
Yeah, yeah.
You understood. You got full disclosure.
Yeah, I know on the federal level, you know, they're the terms that, and unlike you guys may or may not know these terms, like there's the accredited investor, non-accredited, sophisticated, and I know that's why, like I said, when you're coming in with a company and you want to raise money, you probably want to deal with somebody who's an accredited investor. And just from the fact that, based off of how the terms are with the federal government, they're supposed to understand what they're investing in.
Well, right. Okay, so underneath the federal side,
Yes.
versus the state side, state has certain verbiage that they have for investors. The state does not, at least the state we're in here.
Okay.
In the state of Nebraska, the state does not have any verbiage for an accredited investor. They
Okay.
they have disclosures. And that's what the state is for. The state itself has disclosures that you must make sure that the people who were excluded at the creation have to get full disclosure so they can make an informed decision. And that's what your state's there for. I mean, I tell everybody, you know, contact your state and find out what it is. It's not my responsibility to tell you. You have the business. Wherever you founded your company in is most likely the state is going to be governing what you're doing. Okay, so if you founded your company in Alaska, you need to check out the state office in Alaska because you got your certificate there, so they're going to tell you what the regulations are for you to operate, okay? Now, on the other part of it, if you're going to talk to, the reason on the federal side is because if anybody who's an accredited investor, okay, that fall in that category can actually afford to lose the entire investment with you. That's a federal criteria. That's also a criteria that goes through from the IRS, and they have a standard. You know, that standard is you got to make $250,000 a year as an individual, or with your wife, you need to be making over $350,000 in a 12-month basis in the last 2 years, with the expectation of making the same thing. That's the lowest form. That's just as an individual. Yeah. Then they have it for companies that's accredited. Then you could be accredited trust. So they have all of these different things that tell you that you can afford to lose every dime. Now you say, well, what was the purpose of that? Because the IRS is looking for GDP stimulation. So if you have this kind of money, they also give that person who does make those allocations also a backdrop saying that, and this is the IRS. You want to seek the IRS to see what they have to say. Don't just listen to what I have to say on it. I'm actually giving you a little brief synopsis of what the IRS says. But they're the ones who govern that. So not after you went to your state to realize who governs the way that your certificate is, now you go to the IRS and you find out from them. But the key to that for anybody who is an accredited investor, who shows they can make $250,000 as an individual or as a company that's accredited as a company that meet that criteria from filing their taxes, okay? So it's a thing that is done and screened by taxes. So you're not going to be able to tell somebody you're accredited and then your tax records prove otherwise, okay?
Yeah.
So it is, and then you get an exemption with the Securities and Exchange Commission. So then that's another location that you would go to make sure what they have to say on it, on the federal side. Well, I gave you all of that, and it's not as complicated, but it's at least giving you guidance on who you have to go to for what and when. But it gives you this, it really helps you to understand this. An accredited investor is a person, normally,
Yes.
okay, that is not looking to actually help you manage the company. They're looking, they make enough money where the IRS is saying you can now deploy some of those resources. Instead of us overpaying us in taxes, here's an exemption that you can use. Go fund this company. Instead of, because remember the IRS don't fund companies.
Yeah.
So they'll use American citizens that they can go ahead and they give them exemption that they can utilize in order to do what? Stimulate GDP. In the process of stimulating GDP, you may find out that you got $250,000 that either they would have paid it to the IRS, and the IRS would have took that money, and when the IRS took that money, it didn't go to a business. Yeah. So they now have produced programs that it's a way to say, okay, if you file a certain form and you meet this criteria, you'll be able to do funding so these people don't have to go to the bank get a bank loan. So they have a choice. I mean, if you talk to certain credit investors, they'll tell you, I got a choice. I can give it to this company and make more money with tax dollars, So I can make more money with money that was normally be paid in taxes, or I can actually. So those are good people to know.
Yeah.
Because at that particular point, the pressure's off. But here's the other side to it: the pressure's still on, because an accredited investor wants to see 3 to 10x as well. They don't have an interest in just deploying resources, even if it is tax dollars. You know,
want to make sure I get a return on my investment.
If you think that you had to give, let's say if your accountant or whoever does your taxes says you got to pay $5,000 to the IRS because you owe this, but they say, oh, but here's the thing though, the IRS stated because you fit the description that instead of paying them $5,000, we fill out this form because you meet it. You now can invest in a company, but here's the thing: you must take an equity stake and you got to get a K1. So automatically say, So I had to get a K1. What's the reason for the K1? So it actually reports how much money that you put into a company. That's what a K1 does. People don't realize that.
Okay.
A K1 tells the IRS how much money you put to establish this company. If my accountant told me I had to go, I have a choice: pay the $5,000 to the IRS or take $5,000, invest in an early stage company. I'm gonna invest in an early stage company.
Definitely, yeah. To avoid that tax bill.
Because I could take this $5,000 and go out and make $20,000, and out of the $5,000, to give you an example, the $5,000 would have normally be spent, but now I'm able to deploy that $5,000, and that $5,000 now go out and makes $20,000. The taxes on the $20,000, let's just say worst case scenario is $10,000, but I still got $10,000 off money I would have not be able to make $10,000 off of.
Yeah.
And that's what that incentive is. So people, when you're thinking about going into becoming an investor, and you say I'm a family member friend and I'm an angel investor, which means this person is not a family member friend. I need disclosures that basically tell me you can lose every dime of your money over the course of this, and you may never get it back. I need to see that about 18 times in the document.
Yeah.
You're gonna lose the money. It could be lost the money. It could be done. You know, and I say 18 because I wanted to be so clear that you can lose every dime in this investment, so that there is no claim to be placed against the company nor you for not disclosing things. There's nothing worse than not having you can lose every dime. I mean, it is always written in black and white.
Yeah.
In any type of federal related securities investments that you could lose. There's a strong possibility we may fail. Would a family member friend be able to stomach that?
Probably not.
Right. Because the only thing I want to hear is we're going to win.
Yeah, we're going to win. I'm going to get you your money back and then some.
Right.
Yeah.
So in the world of corporate investing, in the world of being to striving to do these types of things, it does eliminate tremendously a lot of people, and that's why funding is so limited right now, because regardless of how much people think it is, it's not that it is a lot of wealthy people. However, they don't do the type of investments we on the show talking about today.
Okay.
You'll find middle-class millionaires. Let's be honest. I mean, 99% of the NBA, NFL, and any other Major League Baseball, someone who makes $100 million, that's upper middle class. People are like, oh, they wealthy. They upper middle class. They upper middle class.
Yeah.
You saying $100 million is the upper middle class? Yes. They're in a union. LeBron James, Steph Curry, they made their contracts are 300-something million or 150 million. What are they? Upper middle class. They're union athletic players. They pay a union fee. I don't want to diminish the fact that they're athletes, but I will tell you that they got the railroad. The UPS just got the largest raise in the history of union workers. They even beat the NBA workers. People don't realize that. Collectively, which means everybody got something. Okay. Normally, the NBA is subjective. One person gets something, they get rid of a couple players.
Yeah,
this means that
in order for me to pay you,
right,
we got to lose some people.
Yes. And this here means everybody stays and everybody makes more money. Even people who are bench riders, even any people who are part-timers. Now, I'm giving you a lot because what ends up happening all the time is sound bites over actually understanding. Sound bites are not enough information for you to operate off of, because that'll actually make you make an unwise decision.
Yeah. A
sound bite. And I always tell people, you don't want to have enough information to be dangerous. You want to have enough information to keep everyone safe, not to be dangerous. Because sometimes we repeat things that we have just on this. We're dangerous at that point. We're not safe.
Yeah.
Because execute it. You think somebody said right now, I'm gonna go talk to my friends and my family and get money. Their company's already started. They're gonna have a violation with their state that they operate in. If one complaint goes, they're gonna have a problem with their state. How come? Because the company was already established, and they provide the guidance if the company's already established for full disclosure to those individuals. Each state has their own policy. That's the reason I warn people of that. So people say, what do you mean? Well, once a company established, what happens if it's after established? Well, the state says there's certain verbiage you got to have. And part of it is I gave you a clue. You're going to lose the money. You're going to lose the money. You're going to lose the money.
So
that's
yeah,
it.
So number one rule when if you're looking to raise money from friends and family, let them know up front, let them know in the middle and on the back end. You can lose all of your money.
Correct.
And if your friends and family they can't stomach that.
Correct.
Then don't ask them for money.
No, actually, that is the greatest lesson that I tell people that when they do come to me. They're just looking for money. And I said, okay, what happened if I lose all the money? And they were like, what do you mean? You're not going to lose any money. Let me just explain something to you. The only way that my money's not lost is if when you stop being a steward and start being a person who just allocate funds in a way to not generate returns for each owner, I have to get involved and keep the company going, and then not only pay myself back, pay somebody else back. So if that person on the other end say, well, if I can't generate enough money to pay you back, are you going to step in and become the CEO, and then I'll become a worker for you? And now I resign from the CEO, you become the CEO, and I become marketing or something else. Like, no, I'm not doing nothing.
Yeah, that reminds me of a conversation that we had a while ago, and when you mentioned, if I take away your product or service,
correct,
how do I get my money back?
Yes.
And that's really the number one question that you need to answer as someone starting a business. If I remove this and I give you money, how are you going to return my capital?
Right. It's a riddle that needs to be solved. Okay. Yeah. And this is true. I do ask somebody, if I take your product or service, whatever you pitch, when you're pitching a vision and you got a protection in your mind of that vision, and you're looking at your product, what product you bring into the market, and I asked, well, let me take that away from you. How do I get my money back if you no longer have that? And the floored look on people's face, like, well, I won't be able to pay you back if we don't have this product. Then you're not a business, because a business is not based on one SKU. And I use this as an example because and I try to look at it about a grocery store. If sometimes you go in the grocery store, you ever had a product with discontinued?
Yes. And
you're going to look for it and say, we no longer carry that. Well, the store's still there. But if that store was full with that one item, which that's the only thing that you're offering right now, the discontinuation of that product is catastrophic. And the only thing you're telling me is you got one way to generate money through that corporation. And it's that I have to take 100% of the risk and you get 100% of the pleasure as long as this thing is on the shelf. It's better off really telling somebody, listen, I started a business. I need you to be a partner so you can pay. Prior to me starting the company, I made certain decisions in my personal life. And I chose to go into debt. It's around $50,000. So I can run the business, but the business itself, I didn't save $50,000 before I started the business. So what I need you to do is I need you to invest $50,000 so my personal obligation get taken care of. Then I'm gonna get the next investor to pay for. I can get the inventory for this concept that I want to do. People are like, what the heck? You want me to?
Yeah, you want me to pay for your debt?
Yes, that's really what most of the people that come across my desk. That's why it's very few can get funded, because that's what they're really asking. They're not asking. They quit their job to say, take my debt. And I don't get none of the fringe benefits of your debt.
Yeah.
And then, I jokingly said this. I would never say this. But before I got married, I said this. You throwing your wife in too then? Politically, that's not correct. But,
yeah.
I'm not asking it, I'm just saying you're throwing what am I get out of this other than I'm paying your bills and you're throwing your wife? Because, at least you're not taking care of her. I'm taking care of her. So at least I don't have to have physical intercourse with her. But heck, when I'm bored, want to go see a movie, we could sit in two different. She could be back there. I don't care. When I want to go to the movies, though, you got to throw her in. I ain't getting nothing else out of this transaction. I might as well have somebody that they know I meet their bills, and at least they got to do what? They don't have to entertain me, but I don't have to do stuff by myself no more. Cause
yes.
and I said, well, you could come, but you sit out in the car. I'm already taking care of your bills. You want to get a free movie too? At that point, they all mad. I don't want no money from you.
Yeah,
but I used to do that back in the day to blow people. We call them spinning them. Just spin them out of there, Because the idea is, the goal is to create something that removes some. Okay, if you're creating a company or you're going into business, and let's assume, because Nexyz Capital is in real estate, okay, And it's not just real estate, just one of the ways you make money, if I'm not mistaken. But let's assume somebody just does real estate, right? Real estate is a fixed asset. It is centered around bonding, and people don't understand it. It's a bond. A lease contract is a bond. It's a local municipality bond. And I share that because when people go into these businesses, they say, I'm doing this because I want to be a bond writer.
No.
Now you see what I'm coming from. So they're so excited about real estate, they're missing the concept. The real estate itself doesn't generate any money. The bond that's attached to the real estate does. That lease contract or the note, promissory note, if you own the building and you own it free and clear and then you allow somebody else to take it over, if it's rented, promissory note is a perpetuity. A perpetuity is a bond. It's a 30-year bond. It could be a 15-year bond. It could be a 10-year bond. Next, somebody goes into real estate and they already have a bond against them, so they're writing another performance bond called a lease contract. It's a performance bond. It's a local municipality bond. People are very excited to go into a fixed income area. Boy, I'm in real estate. I get I lease out. I get $1,000 a month. Okay. At the end of 12 months, it's not like it's a rising. At the end of the 12 months, you do another one. So it's a bond. You write a 12-month lease. You got a short-term bond. You're a bond writer. No, I'm a real estate investor. You're a bond writer. Stop using marketing terms that make you feel special. You see what I'm coming from?
Yeah, I do. Yeah, I remember, before I met you, I was on that getting ready to write these bonds and raise this money and not knowing the full picture,
right.
and it was, the funny thing is, this was right before COVID.
Okay.
So, the pandemic hit, all of a sudden, they were like, hey, there is a moratorium on rent. Nobody has to pay rent.
Oh.
So that comes back to, if I take away your product or service,
correct,
how do I get my money back?
Correct.
And most of the people who were in real estate, well, I can't just write you a check today and pay you your money back today. I gotta wait till the rent comes in, but now rent isn't coming in anymore.
Yes.
What do I do?
and that's what happens when you build your company around that one item in the superstore, in the grocery store. And I've said it to people. You can't afford to be dangerous. See, that's dangerous.
Yeah.
You were dangerous. And there are people who have been dangerous for years. I mean, they have been extremely dangerous for years. And they continue to be more dangerous. They continue to walk out on the balance beam without a net. A business is not designed for one SKU. It's not designed for one flow. It can have, and I mean, there are certain things that you would separate and you would have that's where the LLC would come. It would hold it, and it'd be the pass through to bring that guard in that you would lend the money to the LLC in that regards. And that's going a little bit more detail, but from a standpoint of understanding when a person comes and they say, what am I looking at? I'm looking at the person to see, one, are they obedient? Wealth comes by obedience. The same way that getting good grades in school come from the discipline, the resiliency of studying the work and being obedient to respond to the answers according to what the assignment was, right? I'm considered a good husband based on my obedience. I'm considered a good father based on my obedience to what the good father standard is. And this is a little joke for you and for the listeners. However, being defined a man is not based on obedience. And if you don't be obedient, you say, well, you're not a man. Well, that's not the definition of a man based on what you get from me. Now, I'm not saying that to be facetious or rude. I'm just saying that some of the standards that people put on, that they bring that behavior to a business. Well, you're not really invested because you didn't give me money. You're not really invested because you're turning down deals. An investor's first responsibility is to protect his money. So saying no has to be, you have to be strong in no and really limited in yes. And your yeses are not only is calculated, is that you are tapping into revenue. And I think that's what some of the early stage investors don't understand. That sometimes they're not ready to talk to a corporate investor. They're not ready to speak to an accredited investor. They're not ready to speak to even an angel investor because they're just dangerous themselves. Now remember, that's why I think it's important for all your listeners that follow you, is to understand that you can learn this. You can learn how to be a steward. And you will have to tap into the fact of, I call book bag mentality. Now you say, what is that? When you get your paycheck, the entire paycheck, provide for others. No, I can't do that. And I tell young men that, they single, they're not married. I can't do that. See, every dime that you go generate for the company belongs to others. The stake that you give yourself is what comes from what you retain. After you pay them, what's left over is yours. They're like, no, I got to pay myself first. You hear that a lot.
Yeah.
Pay yourself first. Not when you're a steward, because it means it's somebody else's money. They must get paid first. And if they get paid first, you will always get paid because you have access to people that's always willing to make sure you get paid. But when they don't get paid first and you get paid first, then you lose access because you are growing a management team and a group of individuals. Because I'm saying, instead of you investing in Apple, instead of you investing, remember Sears Roebuck when I was young and it came to the States, that was a company my parents would shop at. And JCPenney still exists today, so I don't want to use them as an example because they still have a storefront.
They're barely hanging on, though. I mean, like I said, I worked at Sears back in the day. So
okay. Sears Roebuck. Okay. So you see it, though. Now, they're not here today. What took place? They were here for years. How does a company start off, have investments, but was in people's 401ks, and they gone? It's not the founders. It's the next generation who came in. When the founders stopped being stewards and they bestowed it upon college degree people and they only paid themselves, there was nothing left. And then you get another cycle of that, another cycle of that. The ones who are stewards first versus give me bonus stuff. Capital, if they are stewards first, they can grow a company where everybody makes money together. Does that person that is sitting in front of me have that mentality? Are they really doing this? I created this company because it's going to give me the identity I always knew. So they projected themselves like a movie screen and say, this is where I see myself and I need you to help me get here. And all of the luxury things that I think would bring me peace, but then I also realize it'll bring me a burden because when it's time for me to pay you back, I can't pay you back because I spent the extra cash that you should have been getting back along the way in some of the frivolous activities in that image that I had. But still give me your money.
Yeah.
Now, can someone who made that mistake get involved or get somebody who has skills that can help them? The answer is yes. If they're willing to. If they're willing to say, I want to be a steward. Because that's really what's taking place. I don't have any problem with any CEO in America making a bonus check of $50 million to $250 million. I don't have no problem with that.
Yeah.
As long as his first criteria is, everyone else had the opportunity to make money. And the ones who don't make the same thing, they also have to accept that they chose not to be in the hot seat. They chose not to do the day-to-day. So they're going to make money according to how much they contribute. And if they're able to make 250%, and it's maybe not the 50 million because he's actually driving, I don't have a problem with that. I only have a problem when the company is designed that allocation of capital is done in a way that no one can get any money. Yeah. It's done in a way that if I take your product away, the X factor. The X factor is answering, if I don't have nothing to sell, can I still make money for the company? And the average startup, the average even company that is running with whatever problems that they have, even if they have 100 different SKUs out there, or a service, if you take the service away, they dumbstruck. That brings me great concern. Yeah. It really does. And it's most likely I would not invest in that company.
Okay. So
long answer to it.
Yeah. So that brings me to my last question.
Yes.
So as a company starting, how long should we actually fund the company ourselves, or aka bootstrap the company, before we come searching out someone like yourself to bring in extra capital?
Honestly, to every one of the management team members, realize that they have so much in stake that they have to generate money if that product doesn't work.
Okay.
So if a person says, well, and I give you this, if the current company is, and you'll see this a lot, and I say you'll see it a lot because it's really, they're not trained and proficient in this area, so they're going to base it on current bills, like what they have, okay? So they're not going to base it on what they can get, but what they have. So if I only have extra $250, I need $150 for myself. I'll give $50 to you. Yeah. Notice what I just said. So I'll give you $600. I might have put in $5,000 and I'll give you $600. Next year I'll give you 600. But now all of a sudden, what is my skills on what I gave? And that's not correlated. I gave you a total of, $6,200.
Yeah.
But I don't have skills that can generate $50,000. So I'm gonna ask somebody else to give $60,000, but do I have skills to generate $300,000? The answer is no. Well, how much money has I been able to return to me? Like, if I got in 6,200 over the course of 12 months, based on whatever the product offering to the market is, have I been able to return to myself a quarter? And I said this: use a 1/4%, 50%, 75% here. That way, that's $1. So you can look at or 100%. Have I been able to return a 1/4%, generate money, have returns, so I can generate money, have retained earnings to keep the company going, and I return a principal. You only can do 3 things with the money. You can put all the money back into the company, grow it. 2, you can actually take half of the money and put it back into the company. The other half, you can use it to pay back what you bootstrap the company for. Yeah. Or 3, you can do a mixture of all 3 of them. You can give yourself back money. You can actually grow the company, and you can actually grow in a company. You can bring a new offering that may be associated with a different company. And that's, I said, at 3 magnitude, where now I did a strategic partnership. And as I did a strategic partnership, I also it's the pizza theology, okay? All right, so you got 12 slices of pizza.
Yep.
Okay, I started my pizza shop. And you said, I tell you what, I have my own company, and I realized that I don't know anybody, and you got 100 people that go in your diner. This is what I'm willing to do. I'm willing to buy all the tomato sauce. What would that cost me? Let's say that cost me $5,000. But every pizza that you sell for $12, it now has to be $14. It got to be $14 because there's a slice in there for me. So if I don't do anything else, I know I'm at least making $2 on every pizza you make.
Yeah.
That's cell phones and cell phone carrier. That's the pizza.
Okay.
So now I have my own business, but I also make money from strategic partnership where I invested into a company so they can have their inventory. And in the process of this inventory, they built in this collective, which means the investment is we now have a deal where I don't go into their company, they don't come into mine, but I actually partner with their company where now when they do their product, my return is in there. So it may be a little bit more, but if the piece is 14 and their cost is, and they're selling these in volume, then it makes sense. I do it. How come? Because now if whatever that I'm offering, let's say I have a dog walking, that even if I don't have a dog to walk, I got pizza money.
Yeah. Cool. I understand that. Yeah. So you want to make sure you have a product or service, build in that investor's profit, so that way at the end of the day, they are getting made whole.
Yeah, it's because your value proposition that you offer, whatever it is, a product or an actual service, the consumers that pay for that they're also responsible for the pay to return. And a lot of times the numbers are not right. And if the numbers are not right, then they can't. So, if you're out of $1, if you take 20 cents out of $1, that 20 cents is allocated back to return capital. There may be another 60 cents in there that's to grow the company, another 20% for retained earnings in case you come up short on that.
Yeah.
If you don't have it built in, then you'll say, well, I got to make money for my investors. It was never built into the deal. So you didn't have it in your numbers, so they can't get paid. By design, they're not getting their money back. You're going to have to come up with another idea at that point because you originally did not design the product when people bought it to pay the people back.
So, guys, I want to thank Primo for his time today. He is a very busy man, so I'm not going to take up too much more of his time. But I'm going to put all the information for his company in the description below so that way you guys can contact Primo and see how you guys can actually work with him. And even if you're a good fit, because you might not be a good fit for his company and what they do. So until next time, my name is Brian Johnson. Make sure that you like, comment, and subscribe to the channel. I'll see you next time.